Hello and welcome to day number 60 of our Travel Trader series, and I called the episode today Money for Nothing. And the reason for it is that we had an extraordinary week. You already know we crashed down a lot. Indices are down. The S&P 500, so 500 biggest stocks in the United States, they are down minus 9.32%. Then we have the Dow Jones Industrial Average. That's the 30 biggest company in the United States. That's down 11.75%. And if you want to compare it with some European markets, you can have a look at the DAX. So that's the 30 biggest companies in Germany that are listed on the stock exchange. And they are down minus 10.32%. Now we can already see a little bit of volatility, which is one of the topics I want to repeat again today. You know, volatility is when the candles become big and when the prices go up and down a lot during any given day. And we can see that although all these indices dropped, obviously the smaller indices like DAX and Dow Jones dropped further than the big industries, the big index with the 500 companies. And we also had a measurement for volatility, and we used something that we call the average range. As a little reminder, if you have a candle, we not only look at the body part, but we look at the whole trading range that we had during a given day. So we go from the high to the low. That's our actual trading range. And the bigger that is, the higher the volatility in the market. And we have the average trading range or average true range where we can measure it over a period, for example, 14 days. And if we have a look at these, we can say that the ATR for the S&P, that went up dramatically, and it went up nearly 87%. So our trading range increased a lot, and the reason for it is just that the market dropped very, very quickly. Within a week, losing 10% is very, very extraordinary. I think it's the biggest drop that we had in the last 50 years, if I researched it correctly. So volatility in the S&P is up 87% in terms of ATR. If you check the ATR on the Dow Jones, that's nearly as high up as the S&P 500, and that was plus 74%. And if we have a look at the ATR in the DAX as a representative for a European market, we see an increase of 85%. So the volatility for all these markets is kind of exploded and is really, really high. And that's the point of our trading idea, because we know we cannot drop endlessly forever, because when we reach zero, all stocks in the world wouldn't be worth anything. That's not going to happen. And if we would drop another 10-20% from where we are right now, we would have a really, really major crisis. But right now, what I talked to you already at the end of January, when we just had a little dip and then we went up as if nothing happened in terms of the coronavirus in China, is that people vastly underestimate the impact that that virus or the closure of the manufacturing plants will have on the company's sales and on the company's earnings. And that's exactly what happened here. And if you underestimate something, sooner or later reality will hit you, and that's what happened last week. So we already knew the week before, on the first day, as our indicators told us, we are going down. That was when I was on holiday in Jordan. But many of my students made a lot of money out of it, because it just keeps dropping and dropping and dropping. So we knew it in advance, and that's a good thing. And now we have a very high volatility, and we know that sooner or later we are finding a bottom, and then we will either go sideways or slightly up again. or depending on how the news from China will arrive, we might even go up very, very quickly again. In both ways, we have an instrument that is called Volatility Index. And that Volatility Index, or short VIX, measures the volatility of the S&P 500, or in terms of the Dow Jones, it's called VXD. So the VIX is something that is calculated with a kind of complicated formula by the Chicago Board of Options Exchange, and they put in the options data in order to get number of volatility, expected volatility over the next 30 days. And V rose really, really big. This one, within a week, went up 235%. And the VXD for the Dow Jones went up even more, plus 240%. I didn't have a look at the VDAX, which would be the volatility of the DAX, because I like to do these with US indices. And now what we know is we have a volatility on a very, very high level. And we know that that drop cannot go on forever. And as soon as that drop starts to hold, or doesn't move anymore, we know that the volatility will come down. And the volatility will come down massively. As you see here, it's 2.4 times as high as it was just a week ago. And even in that week, it wasn't really high, but it was higher than normal. So we have a huge potential of both of these indices going down. And that's exactly the money opportunity that I'm talking about here, or money for nothing. So we short these indices, which are currently at a very, very, very unusual high. Then as soon as they drop, we are making a lot of money with every point that index drops. And we know that volatility cannot be high forever. We can foresee it, that sooner or later we will stop dropping, and then we will have something that is called money for nothing. Now, if you're trading it, be aware we still will have time of increased volatility. That means we won't go back to normal and just do our small increments that we had before, but volatility will get far lower. When we look at the current markets, we can already see some signs, not yet of recovery, but of potential recovery. We see that we are at a level, for example, in DAX, I already told my students in December that once we start to drop from the all-time high again, a retracement down to 11,800 points would be quite normal. We went a little bit lower, but then we went up again. I think we closed at around 11,850. So it's a pretty perfect level for retracement. And I expect that the next week will be a week where after the 5 days, the markets are probably higher than before. Unless we see something unforeseen happening in China, which I wouldn't expect. If you have a look at the numbers of infections that are coming out new, they are actually coming down, so they are not growing anymore, we are going slightly down. So it seems that the peak of that coronavirus threat is over, and that more and more companies now in China start to manufacture again. Now that doesn't mean that everything in terms of the supply chain will be alright within a week or so, but it means that we now slowly get back to more normal times, and when times are normal, volatility will go down, and we would call it a volatility crash, and that's our chance to make some money in either one or both of these indices. Be aware that if anything happens, we might have some spikes in volatility, so you need to make sure that you have a very wide stop loss, just in case if something in the news happens, you might have a volatility spike, but then it will go down. So that's the idea for the day. We can have money for nothing actually by knowing what will happen in terms of volatility. As we don't trade options in this class, or as I don't do this about options trading, we're not talking about volatility crush using options, which would be something that we could do as well. So we are using the index here in going short in these indices in order to make money when it goes down. If you have any questions on that, let me know in the comments. Looks very, very promising. As I told you yesterday, I already entered the market. Trade is up in our mentoring portfolio around 350 euro or so. So I'm looking forward to that volatility crush happening next week, making some money, say thank you to the market, and then move on and use that in some other trades. Thank you very much for watching today. I hope it was something that's helpful with your trading as well. And looking forward to talk to you again tomorrow with a different topic. And wish you a great evening, happy trading, and goodbye.